if you fall asleep or you get hit by a Mack truck, God forbid, no. If you take nothing away from our time together today, and I'm highly confident that you're going to walk away with some real jewels. But here's the thing, write this down. Ask the question when you're working with your high net worth, the first $200 million net worth client that I picked up, I asked him 2 questions. The first question is, would it be interesting to you to know that capital gains taxes are optional? Pause, wait for that to sink in. And I could tell by his eyes, watching his eyes and the tilt of his head, he thought he had misheard me. I said, no, you heard me correctly. Would it be of interest to know that capital gains taxes are optional? You don't have to pay them, and you won't go to jail if you do something else instead. In fact, would this be of interest to you? Because I could see I got a zinger on that one. Again, watch the eyes, look for the head tilt. I said, would it also be of interest to you to know that estate taxes, state or federal, are also optional? You don't have to pay them. And if you have to do some other things instead, and that's what we do. Now, if they say, well, how do you do that? You say, well, that's what you need to hire us for. So anyway, and then you scramble and come back and talk to your people and say, how do we do this? But anyway, set the hook, try those questions. Trust me, you are going to open up some enormous doors for you. Okay, so let's see here. I think that is everything for right now. So let's dive in. Okay. We're going to talk about selling appreciated assets using some IRS-approved, but still little-known strategies. And most excitedly, we're going to be hitting up the primary one, Opportunity Zone funds. But there's some other stuff in it I want to share with you as well. One of the things that I call just a private philanthropic trust, or a PPT. Again, these are going to be at a very high level. How about this? Did you know there's such a thing as a 40-year tax-deferred installment sale? Now, Metropolitan Life has been doing this for years, and some of the other insurance companies as well. Going to fly through that, but it's a way, basically, it's a timing device. It doesn't eliminate taxes, but allows us to defer the recognition of the tax to the timetable of the seller, as opposed to IRS's timetable. And by the way, I'm also going to give you a second idea all tied into that if you're in the ag space, if you work with anybody that's farmers or ranchers, you're going to want to know about Ag 453 before we get done. We're going to then pivot. Just finished literally on Friday a sale of a $3.8 million, helping a client with a $3.8 million sale of an apartment building. And how did we then come in with some ideas to help him eliminate or actually defer any tax recapture, depreciation recapture tax, or capital gains tax? So that, time permitting, we'll dig in a little bit on that, but mostly we're going to be talking about qualified opportunity zones. So, ready? Let's dive in. Hope you got your notepad ready to take some things down. So door number 1, the PPT, as I like to call it. Now, this is a terrific idea, both for before a sale event. So ideally, we retitle the assets into the name of this PPT. It's a private or personal philanthropic trust. So it has some philanthropic benefits as well as it has some enormous tax benefits. But if we have the assets inside of the PPT, which can include real estate. In fact, we can even leverage, we can even borrow money. Banks will actually loan money. Now, if you couldn't do this, this was a charitable remainder trust or a CRT. So I'm not talking about a CRT. This trust, you can actually borrow money and the depreciation passes through. You get tax deductions, also provide a share of the interest deductions if in fact you're using leverage and buying real estate. But if you have stocks, bonds, ETFs, whatever, terrific. You can put them in here. You not only, when the liquidity event occurs, there's 0 tax on the liquidity event, but you then also get a tax deduction. I'll show you that in a minute as well. But this is a fabulous tool to use if somebody's already gone over the cliff. That is, if you've already had the liquidity event, wouldn't it be nice to know that there is an ambulance in the valley along with a very strong net? And the answer is yes. So here's some some case facts. I was hired by a lovely couple. He was 79 at the time and she was 83. They'd sold their business and land for $7.5 million and unfortunately created a $2.1 million tax bill for themselves. I did discover after they hired me, I discovered that they were very, very philanthropic. And actually, although we lost him, Ben, I'll call him, we still have her with us, Eileen. Again, I'll call her that name. Ben and Eileen Dover. And so she's still with us. But I found out after they had made the sale, we only had 3 months left in the year to do some quick tax planning. So here's what we recommended. We put $2 million into the PPT. We created a $1.6 million deduction for doing that on $2 million. It's an 81 cent per dollar deduction. This creates an income stream for the rest of their lives. Now, we can only put this in place after a liquidity event if it's in the same tax year. So if somebody does it earlier in the year, that's a real advantage. But if somebody does it at the end of the year, okay, we can still do this, but we couldn't do it now. We could use the Qualified Opportunity Zone Fund, though. So even if it's 6 months after the event, up until, we can still use an OZ fund. But more, not to take away from what we're talking about there. Here's an additional strategy that we said, okay, what else could we do? I found out they were philanthropic, and I found out that they were planning on leaving their $1.8 million home to charity after their deaths. After I confirmed with them and affirmed that, okay, you're not changing your mind. You are absolutely going to leave your home to these 3 charities. Are you sure? And they said, absolutely, no change in plan. Okay, so what we did is we then filed a life estate agreement, it's called. You see, if you leave an asset to a charity upon your death, okay, great. That reduces your potential estate tax, but it doesn't do anything for income tax reduction. But if we file a life estate agreement, what that does is it splits the asset in half. We might say it bifurcates is a fancy word, just means split it in half. So the clients get to live in the house for the rest of their lives. They can sell it if they need to or want to. But then whatever's the remainder, we call it the remainderman. Sounds funny to say remainder person, but the remainderman, that's what's going to go to charity. And so that can be measured. So we found out by filing a life estate agreement that we created another immediate tax deduction of $1.3 million. So if you're keeping score back home, we basically eliminated their tax bill. We created almost $3 million of tax deductions after the fact. And we also, by the way, what's in it for us? Well, we did charge a consulting fee. We also manage about $4 million of assets. So, it's a great way to find new business. Outcomes, we use 2 philanthropic strategies. We've created future charitable gifts of over nearly $4 million, $2.9 million of tax deduction we created on the spot, lifetime income for them. Great peace of mind and satisfaction. And, oh yeah, by the way, again, we're getting a nice fee for the $4 million of assets we manage. Okay, I hope you can use that or at least get some juices going for you. You won't find it by that name, by the way, a PPT. That's my own name for it. But there are other names that we can direct you to that are actually the technical names for this. The basic concept was created in the 1969 Tax Act. So one of the things to go to Sid's question to me before is, RJ, how do I develop ideas and what can we do for business owners that want to sell and not pay tax or defer the recognition of tax? Well, my answer to that is get very familiar or work with people that are in the space that do this. Learn from them. I'll talk about that more in a minute, but the power of doing joint work and strategic alliances. Okay, next idea, 40-year tax-deferred installment sale. How many people have ever known or have heard that you can sell an asset, appreciated asset, and defer the recognition of the tax for 40 years? Yeah, I didn't think so. I didn't. I only learned about this idea a few years ago, and this is a space I hang out in. So this was a fellow up in Oakland, in terms of both selling a business and real estate. Again, in California, we have the great privilege of having one of the highest tax rates anywhere in the country. Only New Jersey is worse than us. We are 49th, but thank God there's New Jersey out there. For these guys, 1031 was not possible really for the property they had. I mean, basically people want to get the heck out of Dodge. They hate Oakland and, they want to go to Vegas and follow the Raiders or whatever. So I'm going to assume that we, on this $11.7 million combined asset sale, they had about approximately $3.7 million of basis, which means that's about an $8 million taxable gain. And in California, that's 37.1%. So here are the taxes. Pretty nasty, almost $3 million of taxes. So the net result is they would have received about $8.7 million. So what we compared that to was this idea, where we could put the asset. This is kind of traditional, first of all, where you see that the title goes down into the escrow. The buyer comes along and gets what they want. They want the title and they want the property of the assets, and put the money in escrow. Okay, so far so good. That doesn't do anything to defer the tax, though. So here's where we put another wrinkle into the Section 453 simply has to do with installment sales. So in the installment sale document itself, we just insert a little bit of language, not very much, where we create an assignment company, or we bring in an assignment company who steps in, and we treat this as if it was an installment sale, even if it's an all cash purchase. Then that money is directed by the assignment company to the insurance company. We're typically using a South Dakota situs. I'm licensed in South Dakota. And we use that because it's only eight basis points is the premium tax. California is 2.4, Nevada is 3.5. I mean, there's some states that charge a ton of money. So we use South Dakota because it is super cheap for premium tax. We then either purchase a private placement variable life insurance or a private placement annuity. And then that money, when we work with another advisor, they can either be the agent in Nevada and charge a commission, and then we handle the assets under management as an independent registered investment advisor, or we do it the other way around. We make the other person the RIA, and we're the insurance agent. So the money comes out. We typically are using quarterly disbursements. Income comes up to the seller, so they get a taxable income stream. So the earnings are going to be taxable, but the gain on the sale is deferred until that seller wants to start poking around and getting that money out. So are you better off to pay the tax today or wait for 40 years? Well, there's a couple of questions that we don't have good answers for, because we know the gain from the sale will not change. So 40 years from now, it will still be the same taxable gain. But what could change is tax rates. So that's why it does make sense to at least have that conversation, and maybe we do some of both. But regardless, in most cases, most people defer. They don't want to pay the tax today. So what do? Well, we form a sinking fund to make sure they've got the money to pay the future tax. And what's a great place to put money to have it accumulate with no tax in the meantime? And that is creating a sinking fund, maybe using ETFs, but also life insurance. At the end of the 40 years, if we had completely paid the tax up front, that we would have had 8.7 million left. That would go to 16 million using the same growth rate as if we put this full 11.7 into the either the variable annuity or the life insurance, and that would become $22 million. So tax rates would have to change, would have to go up to 72% to just make it break even between the two strategies. And I don't think it's going there. Maybe it should, meaning that we're adding a whole lot of debt to our national debt on its current administration. Not a political statement, it's just a statement of fact. But I still don't see tax rates going up to that level. Okay, I promised you a barn door. Quick idea. Are any of you working with ag families? There's a special subsection of Code Section 453 that allows for a farmer or rancher, it has to be an active farm, active ranch. If they're selling the land, they can defer the recognition of the tax of the sale for 30 years or on production. So if they are growing crops or timber or fruit or animals and they're selling that, they can also defer the recognition of the tax on that sale for 30 years. And we can monetize. This is only for ag. You cannot do this for anybody else. You can monetize the sale. And that is, we'll get them 98% of the net sales proceeds within 10 business days. And after that, it's a 1.5% to 2% fixed interest rate for the next 29 years. So very powerful, very effective. And again, reminder, you can only do this in the ag space. And oh yeah, by the way, we also have a 0.5% of income that we get to receive for 30 years as well. Last thing, and I'm going to really cruise through this very quickly because we want to get onto our big speaker. And let me put this to voicemail. There we go. So what are the challenges very quickly of selling appreciated real estate? Well, First one is you have to find, if you, other than paying taxes on it, that's option number one. But option number two is let's find some things that we can put the money into coming from the sale and defer the recognition of the tax. But that is tough. And you got to do it within 45 days. You have to identify your replacement. And how do you do it and not overpay for the asset you're buying? And how do you get enough income? So flying right through this very quickly, the challenges for finding that replacement asset is what we call the down leg. The replacement assets are usually overpriced and the ugly pup of the litter. And not only that, but under the 1031 exchange rules, you have to exchange the old basis from the old asset into the new assets that you're buying. So what that means is that you don't get as much depreciation, and therefore you have more of that current income, the new income, subject to tax. So what could you do instead? Got a client, as I mentioned, that we just finished the finals on Friday night. 3.8 million, 620,000 of debt, and a $730,000 tax bill. So what you can do is a great way to find a replacement asset is to use what's called Delaware statutory trusts. It allows us to take all of the gains from the sale, and there's no depreciation recapture tax. If there's debt on the property, we can use what are called DSTs that have some debt in them, and which is what we did for our clients. Their debt was about 17%. Now, in this case, we ended up with 3 different DSTs. One is a senior housing project, one's a Hilton hotel, and a third one is recession-resistant real estate with all corporate guarantees like Walmart, Dollar Store, Craig and Automotive. So even if a property gets shut down, all of those corporate landlords are on the hook. So they have to pay the bill, and investors don't miss a beat. So here are some of the other sponsors back behind it that are signing these agreements. So as a recap of the ideas, we looked at number one, the PPT. So you can either have that ahead, you'll get some tremendous advantages by being able to sell the business, the appreciated asset, and not pay any tax on the gain. Or if it's after the fact, you can still do that as well, that ambulance and net in the valley. 40-year tax-deferred installment sale, being able to defer, it's a timing device to recognize the gains when you want to. And if you were working with anybody in the ag space and you want to talk more, just reach out to us. We can walk you through what that looks like. There's some pretty powerful tax judo that we can bring to play there. Deferring taxes on real estate by using DSTs. And now, door number 4, which is deferring taxes using Opportunity Zone Fund. And with that, in keeping with our new administration, we're going to make qualified opportunity zones great again. Well, they're already pretty darn good, especially I've been a hater of opportunity zone funds for reasons we'll probably bring up as we go. But someone said, it's not that the idea is bad. You just haven't met the right sponsor. I said, well, that's a good point. And so I had the great pleasure of being introduced to Pinnacle Partners. We've had 4 major transactions that we did with them last year, over $200,000 of revenue into my firm as a result. And we have now 4 more transactions that are in the process of being lined up because this makes such good sense in the right situation. So with that, Blake Backer, we're delighted to have you with us. So I'm going to turn it over to you.
Yeah, really appreciate it, RJ, and really appreciate the opportunity for you allowing me to present to a group that's been, near and dear to your professional career. So really cool, and appreciate the hat tip on the business that we do together as well, because it's a great relationship and always learning something new. So cool to sit in on the sideline for the first half of this and hear about some other strategies that you're employing, because I'm obviously a little more siloed in what I do on my day to day. So I'm going to go ahead and share my screen here for our transition. But yeah, so I think as you mentioned, we're here today to talk about qualified opportunity zones. You gave a quick intro, but I'll do it again. My name is Blake Backer. I'm the Vice President of Investor Relations at Pinnacle Partners. And we focus on qualified opportunity zone real estate investing. We are also a registered investment advisor, so I'll do our standard disclaimer disclosure slide for a few seconds here, so our compliance team will be happy with me. But I wanted to give a kind of a quick background of who we are, just to kind of set the stage to begin the presentation. As I mentioned, Pinnacle recently registered as a registered investment advisor at the SEC back in 2023. We really started off small at our founding in 2018 when our two founders came together, heard about this legislation, and frankly thought it was too good to be true. And to RJ's point, I think a lot of people were looking at it like it seems maybe like a scam. The tax benefits were very powerful, but and then it's a new program with a lot of nuance. So, but our two founders came together, quickly realized that they had a lot of capital gains on the sideline that could be deployed, and really use their local network in the Seattle area where they're based, and kind of did a friends and family fundraise, I'd call it, just passing the hat, and found some people in their immediate circle to invest in some local projects with developers that they knew who already had projects that were underway that needed some new capital. They kind of felt like that would be the best way to dip their toes into the program, because developers were already building these deals before this program was enacted, and now they figured out a cool and new creative way to get some additional tax benefits along with the potential high yield from going through the development. So we really grew from kind of that local multifamily syndication model to believe this is even a little outdated. I believe we're a little over 300 million assets under management today. We've invested in 17, now 18 opportunity zone development projects. And Nova Gradic, who's a very large national federal tax program expert, they're our tax counsel and audit partner. They've actually recognized Pinnacle as in the top 5% of qualified opportunity zone fund managers in the country, which means a lot because we've been a team of 4 or 5 for the past 6 years, and recently have grown. But very cool to be in that category. And again, kind of what makes us a bit different. We are a fund manager exclusively focused on opportunity zones. We seek best-in-class development partners who do what they do well. They build. They are looking for capital partners like us to find creative ways to finance the properties, and that's what we do well. Is we manage funds, we fundraise, and we certainly do not know how to build. So we seek joint ventures with who we believe are best-in-class developers, in their local markets, with the product type that they build well, and potentially do they have great banking and debt relationships to help us secure financing for the projects as well. So not only do we seek best-in-class developers and think we have a great thesis on what we're investing in, we also have a great practice of really a proven practice of raising private equity from high net worth accredited investors, working with their financial advisors like RJ and family offices as well.
And that's one of the things, Blake, that I love
Yeah.
about what Pinnacle does, is the fact that this is all you do. And the things, the funds that I had looked at before, they were doing maybe a student housing 1 month, and then they were doing apartments the next month. And then, oh yeah, by the way, let's do an opportunity zone fund. They're bouncing around things, but this is all you guys do. And so again, the issue was really, as they say, we're going back to the inauguration next week, and we're trying to get the cold weather gear. And it says there's no such thing as bad weather. It's just bad clothing. So it's the same sort of thing. Yeah. The concept for opportunity zones has been now in the tax code since 2017.
Yeah.
So it's, and you're going to share some exciting things about how it's looking like it's going to be extended as well. But that was what really got my attention. So for you out there that are listening to this morning, one of the questions you want to ask is, if you're looking at potentially working with an opportunity zone sponsor, is, okay, how long have you been in the space? What other projects have you done? Is this what you do exclusively, or do you do other types of projects as well? Now, it's not to say that you won't find someone that can perhaps have that kind of gravitas to do more, but you should still be a little bit skeptical if they say, yeah, this is just one type of project for us. We do other things as well. Oh, really? So, okay. Yeah. Back to you, Blake.
No, I appreciate that. Yeah, it's a good point, because, we have come across, of course, a lot of developers that even we've worked with and other fund managers who, have a great track record in what they do. And then this legislation came out and they wanted to seize upon it, of course, like many people, and found it, hard to do so. So I think, of course, like everybody else, when we started out, it was very nuanced, and the legislation was actually, quite ambiguous and only a couple pages. But, as you mentioned, this is what we do every day and exclusively. So we feel we have a pretty good wrap on it. But yeah, enough about us and our background. Really want to get into what is the Opportunity Zone program, and apologize for being redundant if some of you are quite familiar with it, but I'm sure there are several of you who don't have any experience with it. So I do want to give kind of a high level of what is the program and what are the benefits. So as RJ mentioned, the Opportunity Zone tax program was enacted as part of the Tax Cuts and Jobs Act of 2017, which was then ratified in 2018. And the goal of the program was just really to spur economic activity and incentivize investment into distressed communities, that needed job growth, people, moving into the neighborhood, needed new stock of housing to help, bring the rents down a little bit. So that's really the goal of the program. And when it was co-authored by Senator Tim Scott, Republican from South Carolina, and Cory Booker, Democratic senator from New Jersey. So this does have bipartisan and bicameral support, which is noted. They were trying to think of creative ways. How do you incentivize investment into these communities? Because frankly, a lot of developers who are using large institutions to capitalize their projects, they're staying away from these neighborhoods because they, were seen as not as attractive, potentially not as high yielding. And what they came up with was, why don't we look at all of the high net worth individuals who have capital gains on the sidelines? And these people are not selling, whether it's highly appreciated stock. And I think truly they were looking at tech executives who just have billions of dollars on the sideline, if not more, looking for ways or thinking of ways for them to transact and incentivize them to sell some of their highly appreciated stock to reinvest in these communities. And so, of course, they came up with a tax break to incentivize individuals with capital gains to reinvest in these neighborhoods. And so that is kind of the basis of the program is, incentivizing high net worth accredited investors with capital gains to reinvest into these distressed communities, for the potential of growth and to help these neighborhoods grow. So some key facts about the program, and quite interesting. Really, the IRS and Treasury approached all the different 50 states and said, hey, we basically want you to draw maps in your cities and decide what are below certain levels, have at least 20% poverty rate and are below 80%, the average median income of the city levels. And they really left it to the cities, to draw these maps locally. And, if you look on some of the maps, you're kind of scratching your head thinking, okay, how is this an opportunity zone next to this neighborhood? Okay, this one makes a bit more sense. But, it was a little bit subjective, I think, to begin, but based on the 2010 census data. And so when all the cities and states submitted to Treasury and the IRS, they ended up approving over 8,700 zones nationwide. There's quite a few. So near where RJ and I are in Southern California, you can think downtown Los Angeles, it's San Diego, I believe, where you are, near Petco, there's an opportunity zone in downtown San Diego. And you look at it like, well, there's a lot of nice new development here. It seems like a great area. But for whatever reason, based on the 2010 census, perhaps it was not quite developed at that time, qualified. And so a lot of zones out there.
Blake, in your last project, you had
Yes.
one of the things I was surprised with was to see that you building units in next to Mile High Stadium in Denver.
Denver,
It's
correct.
like, who would have thought that Mile High Stadium was an opportunity zone?
Yeah.
It
Well,
is.
and you think about it, you look at a lot of stadium districts and cities, and they're quite industrial. They aren't zoned for multifamily, right? It's a lot of these kind of surface parking lot, last mile logistics sites, and they want those to have a little bit of a juice to them, right? And so I think the cities are trying to incentivize these larger master plan communities that you're seeing in Denver and Nashville, which is another place that we're building near the Tennessee Titans Stadium. It's quite exciting what's happening, and we like to think it's due to this tax program, right? People are excited to invest in these neighborhoods and hold for a longer term.
And that is one point I want you to bring out is that this is not low income housing that you're building.
Correct. Yeah.
There's a huge, that was one of the other things that really attracted me to the program. And again, for those who are listening, you can ask these questions for potential sponsors you might be working with is, what are you building? And most of them, frankly, don't even have a plan. They just say, give us your money. We'll promise we'll do good things with it because there's all these tax benefits. But that doesn't work for me. I want to know exactly when my clients put their money in, where's that money going to go? So right. I love the fact that you guys fully identify your assets before people are investing.
Yeah, we try to, for sure. Yeah, because I think people want to evaluate some underlying real estate asset, right? Not just I think letting the tax tail wag the dog is what people say. I've heard it too many times, but
Yep.
you want to invest in a sound real estate investment, and then the tax benefit is the gravy on top. But real quick, as we transition, I wanted to point out, surprisingly, the IRS website, very helpful if you have any questions that we don't answer here today. I send advisors like RJ and a lot of individual investors that I work with directly to this site, and they've done a great job of actually laying everything out quite easily to understand, do you or your clients qualify? What are some of the timeline implications, so on and so forth. So I'd encourage anybody with questions that don't get answered to go to the site or to reach out to us directly, of course, after the fact. But quickly talking about the success of the program, as tracked by Novogradac, who's the tax advisor I mentioned, they claim to only track about 1/3 of all qualified opportunity zone funds in the market today. And they've tracked over $40 billion worth of investment. And they feel it's safe to assume there's already been over $100 billion invested into these opportunity zones since the inception, really in 2018, which is impressive. And so when you look at, what have people invested in? RJ made the point, it's not just LIHTC, low income housing. It's not just workforce and affordable housing. There is student housing. There's, industrial sites. There's hotels. It's quite broad. That's just on the real estate side. There is an opportunity zone business component that we won't get into. Our firm does not focus on this, but it has been a wildly successful program from the standpoint of participation and investment into these zones. So now I think what people are more interested in is, what are the benefits? Which of my clients may be eligible? We'll also get into a few case studies, which I think, will help kind of illuminate some of the types of investors that we see on a day-to-day basis. And so kind of taking a step back, I mentioned at the beginning of the presentation, investors with capital gains are incentivized to invest in these zones. So if you have clients who have invested in stock, or maybe they sold some property, their capital gains portion of whatever they sold is what's eligible for reinvestment. The basis can be pocketed, so that's important to mention. I'll bring up a case study later with a 1031 exchange, like RJ went through previously. But if you have investors with capital gains, there are potentially 3 benefits for them to enjoy. So say they triggered a gain at the end of 2024, December 31st, they were doing some tax planning and they triggered a stock sale gain. If they have $1 million of capital gains from selling a stock long-term, let's say, they may owe $238,000 at the federal level. And so what they can do is they can take that full $1 million capital gain and reinvest all or a portion of it into an opportunity zone fund and defer the capital gains tax liability until their 2026 tax return, which they may pay in April of 2027. So that's the first benefit of this program. And I will point out that 2026 tax return date is just a set point in time. So when the program started in 2018, we were investing in projects in 2018. Investors back then were saying, wow, this is like an 8 or 9 year deferral. It's quite a long time. So that benefit, of course, is diminishing as we approach this end of 26 date. But as RJ pointed out, we'll talk about a potential extension for this program, an extension of that deferral date, which has been proposed at Congress recently. So benefit number 1, client with the capital gain, you can defer that capital gains tax liability until April of 2027. The second and quite largest benefit, frankly, is you're trying to achieve elimination of capital gains taxes on the opportunity zone fund investment itself. So if you do choose to invest the full $1 million of capital gains in that example that I just used, if that grows to $3 million over the course of 10 years, the new $2 million capital gain could potentially be tax exempt. And this is really, from what we've seen, and RJ, you can tell me otherwise, kind of a one-of-a-kind program where you really have a definable exit period with tax elimination. It's not a perpetual deferral, right? So there is an actual timeline for exit. And just the caveat to that is these are not, short-term holds. There's a minimum 10-year requirement to hold these investments. And so again, I think what Treasury and the IRS was looking at was, okay, we don't want to allow wealthy people with a lot of capital gains to come in, develop something quickly, flip it, make a nice profit, get tax exemption and move out of the neighborhood. That doesn't really help with the long-term staying power, right, of kind of a long-term hold in these neighborhoods. So one thing that is required is opportunity zone funds and investors have to hold their investment in these neighborhoods for at least 10 years to really, again, really see the progress over a decade, right, of the growth of these neighborhoods and the transition that can happen over a longer term period. And the last benefit, third, is if you hold these for more than 10 years, then you can also enjoy no depreciation recapture, which you may pay in a traditional real estate investment, right? So when you sell a traditional real estate investment, you're likely going to owe capital gains taxes and depreciation recapture if you used any to offset ordinary income liabilities, right, throughout the holding period of your investment. And so, because you're really getting to market your investment, whether it's a single project or multiple assets in a fund, because you're basically raising your basis up when you sell, there's no capital gains tax and there's no depreciation recapture. So it's a very tax efficient and tax advantaged investment when you think about it. So those are the three main benefits.
When somebody's selling real estate coming into the project, because do they also forgive the depreciation recapture when they sell an existing asset, or what happens?
Can be, yeah. And again, I would encourage people to work with their CPA on that, because there are different situations and I cannot give that tax advice, but yes, it can be the case. Yeah.
There are different kinds of depreciation. There's actually 3 different major types of depreciation. In most cases, my understanding is that on this original sale, there is depreciation recapture. But what you're referring to is the tremendous, hopefully, opportunity for growth inside the real estate that you're building there. And I hope you do touch on some examples from your current fund, because just to give people an idea of what that looks like, what kind of projects do you actually work on? And especially this concept of BTR, build to rent.
Sure.
And one of the things I fell in love with about your programs is that these are built for the people that I care about: police, firefighters, military, nurses, social workers, teachers, people that want to live in the same town they work, but they can't afford housing. So what you guys are doing is building affordable, really, but not low income, but housing that people can afford, that's really nice quality and safe.
That's right. Yeah, we like to call it, self-regulated, affordable, little a affordable, attainable housing. There's all these little terms for it. Quickly, we just touched on, what are the benefits for investors. Just also wanted to lay out, what types of capital gains are eligible for reinvestment into these funds or into opportunity zones, and touched on a couple, of course, selling stock, if you're selling a property, even selling a business. So if you've had a multi-generational business with quite low basis and you're selling for a lot of money, decades later, and have a lot of capital gains from that, you can use sale proceeds from a business. We're seeing the return of crypto investors, of course, with the recent run up. A lot of people saying, wow, it seems like we've top ticked for the time being, potentially, depending on who you talk to. Some will hold forever, but we're seeing a return of crypto investors. And then a couple interesting ones, any carried interest that is recognized as a capital gain can be eligible for investment as well. So we've seen a lot of hedge fund managers, private equity principals come to us and say, I've had a lot of carried interest. We had a good year with our fund last year. I need to do something with the proceeds. What do you got? And then partnership interest, which kind of have an interesting caveat as well. So if you are investing, say, in a real estate property with a few partners through a pass-through entity LLC, or a partnership via a business sale, those partnership interests are also recognized and eligible for reinvestment as well. So various types. These are the more popular types of gains that we see. I think I've heard even selling antique car collections and art. If the IRS is trying to collect from you, that it should be eligible for reinvestment into one of these funds. So it's a pretty broad base. We'll quickly touch on this, and I know, RJ, we want to move to Q&A here pretty soon, but regarding the real estate sales, because I know you do this pretty regularly, I just wanted to touch on some main points of really some advantages of an opportunity zone investment compared to a 1031 exchange. And I will say, first and foremost, ultimately, it's up to your client's investment thesis and goals, right? So one or the other may be better based on their personal goals. It's not that one of these programs is better than the other. But as RJ mentioned, a few things to point out. With an opportunity zone fund, first and foremost, it's just the capital gains portion from someone's sales proceeds that can be reinvested and eligible for tax treatment. So, again, if they sold a property for $1 million and they had a $500,000 basis and a $500,000 capital gain, they can pocket the basis tax-free, and then any portion of the $500,000 capital gain would be eligible for an opportunity zone fund investment. So, we like the flexibility there because people can, pay off other debt, add as expense to, lifestyle, whatever it may be. Just using the capital gain portion is somewhat flexible. And then, as I mentioned, with a minimum 10-year hold, which some people do think is a long time, there is a definable exit period where you can achieve tax exemption, right? As opposed to a 1031 exchange where you're really perpetually deferring, right? And you keep trading into a like-kind property until the definable exit period, unfortunately, would be the death step up, right? So that's really the time when, you can pass on the property to the heirs and they can realize the gains tax-free. But if you're trying to achieve tax exemption in your lifetime, we believe the Opportunity Zone Fund is superior. And then, I think the other thing we hear a lot is investing with a fund manager like us, into an institutional style portfolio, meaning groups like Blackstone, BlackRock, so forth, are investing in the types of projects that we're investing in, we're competing for. It's really allowing access to individual investors into projects like these that have really been reserved, for institutions like that. So, we do think it's a great way to be passive, own a piece of a very large portfolio of institutional properties, as opposed to, again, you may prefer this or not, being a more active manager of, say a duplex or a triplex or a single family home, which requires much more active management and responsibility. So, again, at the end of the day, it really is up to you or your client's investment preferences and your goals. But we do think that the OZ program has a bit more flexibility than 1031 exchanges.
We're getting to the magic hour. We're going to do our Q&A here. So go ahead and land the plane as you're able to here. I'm looking at our questions here as well that we've been getting a ton of. These are great questions.
Let's go to these. And, I think I had some case studies here, but we've really touched on all of them, right? I mean, if you get the idea, if you're selling some stock, again, we like to use the case that we're seeing a lot of NVIDIA shareholders today, of course, who've become millionaires overnight, right? And most, if not all of their net worth is based in a single stock. So when you think about advising clients on concentrated equity positions specifically, think about opportunity zone funds as a way to diversify into real estate in a tax advantage manner. That's kind of what we talk about with advisors and, of course, employees of these companies. Real estate sales, we just touched on. Why may an opportunity zone fund be a better investment choice than a 1031 exchange or a DST? It may not, but if your client has more of a long-term appreciation preference for their investment, then we believe opportunity zones have the edge as opposed to a more current income goal with a 1031 or a DST.
Because that is one of the differences, isn't it, Blake, where there is going to be income coming out of the Opportunity Zone Fund, but it doesn't happen right away. So you're looking at maybe 36 months sometimes?
Yeah, 2 to 3 years typically, because you got to think, typically these are ground up development projects or substantial rehabs, and there isn't any cash flow on day one, right? So, we do, like many other funds out there, pay a preferred return that accrues, but it's not current income, right? There's no cash flow to share until there's a building in service with renters cash flow from that, right? So it typically is a 2 to 3 year period before we're, building these properties, leasing them up, refinancing them, and then seeing some cash flow return to our investors. And, again, it's a pretty modest coupon on an annual basis, but the goal is the long-term appreciation that is tax exempt is
because I know we've been talking about numbers. I'm not trying to put numbers in words in your mouth, but I know we've been looking at IRRs of 15%, and that's before factoring in any kind of tax benefits. So these are probably not ideal for people that need income right away. However, again, there's some slices. I've got a new prospective client. They're getting $950,000 from a sale, $500,000 a basis. So they've got $450,000 that in California they'd be paying $150,000 in taxes on. So one of the things we're talking with them about is doing 1, maybe 2 DSTs, but also considered putting some money into the Opportunity Zone Fund because they don't need all the income. but they've got kids that they want to benefit. Well, what a perfect solution.
Yeah.
Put some money in an OZ fund, let that money grow. And at the end of 10 years, when it comes out, there's no tax on the gains. There's no recapture tax on the depreciation that's been sheltering the income. And oh, by the way, for those who are listening in again, we had a case earlier this or last year where just that, as it was said a moment ago by Blake, that the basis you don't have to put into the Opportunity Zone Fund.
Right.
So we had a situation where we put $1 million, about 1.1 million of gain into an Opportunity Zone Fund, but they had $500,000 of basis that they, so they asked, RJ, what should we do with that? So what we ended up doing was buying a life insurance contract. We're using it on a single premium with the side fund. So basically we're putting in about $100,000 a year for each of 5 years. And what the other advantage is Brant, how do they Blake, Brant is my chair for our committee. Blake, how do they pay the tax though? So in either by April 15th of 2027 or what looks like April 15th now 2029, that's when the tax is going to come due on their previous sale. Yeah. Where do they get the money to pay that tax?
It's a great question. So I would say, I know that we've been talking about this. Our goal is to try to return capital by that point to help repay that deferred tax bill. So much easier in our earlier projects. You know, we were starting construction in 2018, 2019. You can think about a 2 to 3 year period to build and lease up, right? There's going to be a refinance event, right? Like an equity out refi is what we're trying to solve for essentially. And so if you can build these, lease them up and stabilize them, right? What we're trying to do is convert the construction loan that we have to build these projects alongside the equity that we've put in and replace the construction loan, right, with a new lower cost, hopefully longer term permanent loan, maybe agency financing. And when we do that refinance event, in theory, you can return capital using the debt proceeds to your investors tax-free. And so we're still trying to achieve that. And as you can imagine, breaking ground on a project today, it cuts it pretty close. Now I will say certain product types, and you touched on what we're doing, we're not really gonna have time to get too deep into it, but product types like, you know, stick framed single family homes and townhomes, as opposed to behemoth high-rise, you know, condos, let's say. There may be opportunities to build those faster and lease them up faster and refinance sooner. So we are trying to solve for that still with our projects. And, you know, I would say, you know, I don't want to throw accurate or, you know, hard numbers out there, but try to return more than the deferred tax payment is what we're trying to solve for, right? And that's changing based on the current debt financing environment. How much equity versus construction debt are we using? So the loan to cost ratio versus our loan to value ratio when we refinance the properties, right? So all these things are top of mind, but I just, you know, I want people to know that our firm and many others are really trying to solve for that refinance event in the hope that we can return tax-free proceeds to investors to repay that tax bill. Having said that, we still advise people really have that money set aside in the event that we aren't able to do it in time, right? Or the financing environment in a couple of years is like it is today, where it's very challenging to refinance and return capital, right? So there's a lot of uncertainty, of course, and we don't want to say it's guaranteed that we're going to return that capital,
and that's where those are listeners. That's where having something like a life insurance contract, where you're overfunding it, you've got some survivor benefit there in case, you know, things get messy, but you're overfunding the contract, and so you're building cash so that you can have the cash to pay the tax. But what is being said here from Blake's standpoint is that, and from my standpoint, April 15th of 2027, which is where it is right now in law, is pretty quick for the properties. Yes, interest rates are going to be dropping. That's great. Very likely anyway. But we got some good news the other day that a gentleman is being proposed to be the new HUD chair or whatever.
HUD secretary.
Yeah, secretary. Talk about that. So is what Scott Turner. That bodes very, very, very well for Opportunity Zone funds, doesn't it? So why?
Yeah, and maybe that'll kind of skip towards the back here. So there's new legislation proposed, or it was even proposed back in 2022, frankly, to extend and expand the Opportunity Zone program. Because of the early success and the amount of investment in the program, there are a lot of working groups and lobbyists, and we know many of them, who are trying to get this program extended. So Scott Turner, who's one of the influential people, who's really a supporter of the program, I believe he was the deputy HUD secretary under Ben Carson in Trump's first White House.
Right.
He was
Correct.
recently announced and appointed as the nominee for the HUD secretary in Trump's second term. So he hasn't been confirmed yet, but he's the nominee for it, along with Tim Scott, who co-authored the program. Is, I now believe, the chair of the Senate Banking Committee and leads the National Republican Senate Committee as well. So the right people are in the right places to have influence, right, from the very top down. We're very hopeful that this program gets extended. And quickly, what could that mean? What's been proposed and what's on the table today? That deferral date, as RJ mentioned, could get pushed out from the clients owing their deferred tax bill on their 2026 tax return 2 more years, so deferring it until their 2028 tax return, which could be paid in April of 2029. That's the biggest one. That obviously gives groups like us more time to build these projects, weather any downturns, right, in more challenging environments like we're seeing today, to keep the projects afloat and try to return some capital to pay that bill. The proposed extension and expansion could allow fund of funds, so that smaller groups could invest in funds with groups like ours. That's currently precluded. A little more technical. And then if they also want to see some more reporting requirements. So what is the actual impact of the projects that have been built? How many jobs have been created, right? What has it done to the demographics in the neighborhoods? They just want more reporting on the impact of the program. So I think we'll see all of this. We're feeling pretty confident that something will happen this year. I don't want to be on record saying when or what that could be.
Plus, Trump's a real estate guy. So, okay, we got a hot potato here because we're at the hour. We're at 11:01 right now. And yes, so those of you who've been asking, this is being recorded. So if you have to jump off, don't worry. We're going to go for a couple more minutes here. We're going to play hot potato, though.
Yeah.
Let's see what else we're asking. So, yes, we can. Most of the slide deck I'm willing to share. There's some non-disclosure kinds of things, like particularly one chart that I showed. I'm not at liberty to share that, but the basics of the slide deck, I'm happy to get out to you. Let's see. Gosh, we have so many great questions coming in. What's a typical investment? So keep it really quick in terms of response, Blake. But what's a typical investment for Opportunity Zone? What's a minimum and what's a maximum?
Our minimums are $250,000. I think I've seen other groups as low as 50,000, some groups as high as $1 million, but ours are 250,000. But I think it depends on fund to fund. There's no uniform investment amount.
Yeah. So I think the target for this fund is at the high end, 75 million for this latest project that you're.
Yeah. And apologies for
million,
but couldn't get into our fund. Yeah. But our current fund has a minimum $250,000 investment. It's about a hard cap of 75 million is our current fund. Correct.
Yeah. But and that's again, what we've been doing is we've been suggesting, okay, let's just take $500,000. Let's take $1 million of your gain and put that away. Now you've got some basis that you can work with. We can put that into some other types of investments.
That's it. Yeah.
And to build capital to be able to help pay those taxes. Why may an investor that recently sold a property choose to invest in an opportunity zone versus a 1031? I think you've pretty well nailed that. I mean, we should look at both aspects of it, but is there any really high level?
I mean, again, I think it comes down to personal investment goals. Do they want to be an active manager of real estate, or do they want to be passive in a fund? Are they seeking, again, a perpetual deferral, right? Do they want to keep trading into new properties to avoid paying the tax? Or do they say, okay, I want to be passive. There's a 10 to 11 year investment period for this fund, and I'll hopefully see tax exempt growth or tax-free growth on that investment after 10 to 11 years. Those are the two I would say are most common that people think about. But yeah, I mean, a lot more to consider, of course.
And what happens if somebody dies before the end of the 10 years? I know you touched on that in passing, but kind of.
Yeah. So I would say, typically you take care of that with your, trust and estate attorney. I mean, we have people investing through, grantor trusts. We have people investing through LLCs. I think typically you're figuring out the succession in the org chart. That's not so much on our end, but of course, it can pass through to a spouse, right? However you've set up your planning upon death. The investment can be transferred with tax benefits intact. We've seen people in their 80s who will not realize, really the fruits of the investment. Maybe, but most likely not.
But their heirs might, right?
Yeah, but they're investing through generational skipping trusts for their grandkids because they want this investment to grow for their grandkids. So we see a lot of different scenarios.
Yeah, it's not an either or. It oftentimes it's an and this, so you can do both.
Yeah.
I'm laughing because someone put in says, this idea just sounds too logical and long-term beneficial for taxpayers than I typically hear about government programs. How is this possible?
I agree. I agree. Again, when we looked at it the first time, we were like, yeah, it's too good to be true. I don't know.
And then someone also asked, how financial advisors, how do we get paid? Well, I can tell you how I get paid as an independent registered investment advisor. We charge a fee. And if you're interested in finding out some more nuances, reach out to me. You can reach out, support@wealthlegacygroup.com. So send an email to support@wealthlegacygroup.com. And I can get into more nuances. But basically, if you have a broker dealer, I'm completely independent. So we don't use a broker dealer, which no offense intended, they don't do anything for me or for my clients. So, what we oftentimes do is actually do it in such a way that the client gets what the broker dealer would have received. We make sure that they get that in their investment, so it actually grosses up the value of their investment.
Yeah.
But we can get away with that because we're an independent RIA. But if you have a broker dealer, first of all, find out what kind of opportunity zone fund sponsors you have available, and if you don't have Pinnacle on your list, get them on there. But then you can place that business through your BD, and your BD makes some revenue, and you do as well. And it's extraordinary. But even if you're just an insurance advisor only, that's where it's so important to understand the mechanics of how this works. So you can do like I did and just take the basis and use that money to invest for the client or buy insurance products or annuities or other things. Annuities aren't super great if you're going to use that for funding the tax that will be charged on the previous liquidity event. So you got to have complete liquidity, but you know where I'm going. So anyway, that's how we can get paid.
Yeah. Real quick on that, RJ, I don't want to go too far over here, but just a thought, because you touched on it earlier, and I think it ties into this. Think about opportunity zone fund investing as a business development strategy for growing your AUM as an advisor, because if you have clients that have held away assets that you're not feeing on, it is an opportunity, again, to bring that investment into your purview of assets under management and charging fees on that. So we have seen that where a legacy property had not been included in a client's AUM, right, with an independent RIA. It's a way to bring it into the fold and help grow your business. So that's something that we talk about a lot with RIAs that we work with.
Okay. Well, we've got some other questions. We will respond back to them later via an email. So I'm just going to sign off here and say thanks so much for tuning in with us today. Again, obviously, we've got a lot of very interested participants today. Thank you for that. A couple of quick reminders. Again, be sure you sign up for our event that's coming up on the estate planning on February 24th through your MDRT Community Leaders Program. Also, annual meeting this year is June 22nd, and that's going to be in Miami Beach. So get ready to have some incredible meeting there. The global meeting is August 24th, and that's going to be in Macau, China. TOT is going to be in Scottsdale, and that's October 22nd through the 25th. And last Edge meeting, which is truly, if you haven't been to Edge, it's a small, intimate, like 500 people. Everybody speaks English. It's a way cool approach as well. That's going to be in Austin. So if you ever heard the saying, stay weird? Okay. Well, we get to find out because it's going to be in Austin, and that's November 10th through the 12th. So with that, on behalf of MDRT, we're so glad you joined us today. I'm RJ Kelly. Thanks so much. Especially thanks to Blake Becker, who Blake just stepped in at the last minute and just did a fabulous job. So thanks so much. God bless. See you soon, I hope.
Thanks, RJ. Thanks, everybody.